What is up, all you beautiful people? Mike Ferrassi coming to you today with a little bit of Mortgage 101, because I've noticed that there's a serious lack of knowledge out there for those people who are new into the mortgage business, maybe in the last 2, 3, 5 years, and they're just not super familiar with some of the stuff that us seasoned veterans have come to know as commonplace. And honestly, homeowners and homebuyers looking for a new mortgage, they can probably get a lot out of this too. So today, it's ARM Day. Adjustable rate mortgages. What in the world is an adjustable rate mortgage other than a mortgage that has a rate that adjusts every once in a while? Well, not much, really. It's kind of what it is, but it's in how that rate adjusts and when it adjusts. The devil's in the details, so let's get into those. A lot of you have probably seen adjustable rate mortgages, or ARMs, referred to as 3-1, 5-1, 7-1, or 10-1. Those are the most common terms. And those terms are referring to how long the initial note rate is fixed for and how often the rate adjusts after that fixed period. If you have, let's take the most common term, a 5-1 ARM. It's written 5/1. I'll put some stuff up over here so it's a little easier for you to picture. A 5-1 ARM has an initial note rate that's fixed for 5 years. And after that 5-year fixed period, the rate adjusts. And it adjusts once every 1 year. That's what the 1 is for. Now, currently, we're seeing the introduction of some ARM terms that look a little bit different because they don't just defer to the /1 on all of those fixed terms. We're seeing 3/6, 5/6, 7/6, 10/6. And this is the exact same thing, only instead of the fixed period running out and the rate adjusting once every 1 year, the 6 means that the rate is going to adjust once every 6 months. So pretty simple, right? You have a loan that's usually going to be a 30-year term loan. Your note rate is fixed for 3, 5, 7, or 10 years, whichever one you choose. And after that fixed rate period, the rate adjusts and your payments recalculated every 1 year or 6 months. But what does your rate adjust to? How much can your rate potentially adjust? Well, those are also specified in the details. The adjustable rate is calculated using 2 factors. You have a margin and an index. The margin is a fixed amount that is set by the loan program of your choosing. The vast majority of margins these days fall in the 2.25 to 2.75 range, but that is a fixed amount that never changes. That is your margin. The index, however, that's going to be based on one of the indices that is common in the marketplace. For quite a few years now, we've been working off of the LIBOR index, or the London Interbank Offer Rate. Though the LIBOR index has been very commonplace in the industry, we're currently at a bit of a crossroads, and we're seeing a changeover from the LIBOR to the SOFR, the Secured Overnight Financing Rate. Much like the LIBOR index, the SOFR also pretty darn low right now and can also change on a daily basis. So keep an eye on what that is, because that is going to be how you determine what your adjusted rate is. You see, when it comes time for that rate to adjust after that initial fixed period is over, the way that your rate is calculated is by taking the margin and the index and simply adding them together. To make math easy, let's say the margin on a loan is 2.75% and the index, maybe it's the SOFR, ends up being 0.75%. So when that loan adjusts, you take your 2.75 plus your 0.75 and you have a adjusted rate of 3.5%. Now this adjusted rate may be higher, lower, or the same as the note rate of the loan. It's very possible that you see minimal difference in payment at all. Sometimes you can see a bigger difference. Sometimes you can see a smaller difference. Sometimes the payment could actually go down. It's not common, but it does happen. And by how much that payment can go up and down is determined by the caps. If you've looked into an adjustable rate mortgage before, you've probably seen caps, adjustable rate, or ARM caps. It's 3 numbers separated by a couple of slashes, and it's really easy to pass over, but they're very, very important. Some extremely popular caps that you see in the industry are 525, 225 or 226. The first number in your caps is going to represent how much up or down your rate can be adjusted in the initial adjustment. So if you have a 5-year fixed ARM, after that 5 years is up, if your caps are 225, then that means that first number, that 2, the first time that your rate adjusts, it is not allowed to go up or down by more than 2%. So you have a little bit of protection built in there for you, even if the index has gone through the roof since you signed that loan. The second number within the caps represents the periodic adjustment cap, which means every time it adjusts, whether it's a year, 6 months, every time that the rate adjusts on that loan, it cannot go up or down by more than that middle cap number. 525, 226, this is usually gonna fall in the 2% range. Most of the caps might differ a little bit here and there on the initial adjustment cap or the final number, the lifetime adjustment cap, which represents the maximum amount the rate can go up or down over the life of the entire loan. But that middle number, the periodic adjustment cap, usually going to be 2%. And the last thing to talk about with an adjustable rate mortgage is the floor. And that floor is the bottom level, the lowest number that your rate is ever allowed to fall to over the life of the loan. And the floor on pretty much all ARMs you see out there, it's just going to be equal to the margin. So if we go back to our example, our 2.75% margin, that's going to be the floor, the lowest rate possible. So even if somehow that index that your rate is based on falls into the negatives, which, I mean, let's be honest, that's really not ever going to happen, but just in case it does, that margin is the floor, the lowest that your rate can ever be adjusted to. So there you go. That's all of your ARM basics. So what does it look like when we put it all together? When we're shopping for a loan, whether you're a consumer and you're looking for your own loan, or you're an originator and you're just looking for the best loan to fit your client's needs. If you're looking for an adjustable rate mortgage, you're probably going to be looking for something that looks kind of like this. It's going to be a 5.1 LIBOR or a 3.1 SOFR with 225 caps. And now you know what all that means. So when somebody says, hey, what's all this crazy slashy dashy computer codey looking type of stuff? You can be the person to educate them on how adjustable rate mortgages work. Because at the end of the day, it's really not that tough. And it kind of makes sense. But if you don't have that information broken down to you simply, it can get really confusing really quick. A lot like most of the stuff in our industry. So look forward to more of these videos coming at you soon. This is Mike Ferrossi, Mortgage 101, and we'll talk to you guys next time.